In 2007, Warren Buffett made a bet. He wagered $500,000 that a simple S&P 500 index fund, a passive investment that holds every stock in the index, requires no manager, no strategy, and no expertise, would outperform a basket of hedge funds selected by one of the most sophisticated investment firms in the world over the following 10 years. The hedge fund side was represented by Protégé Partners, a respected New York firm that selected 5 funds of funds containing dozens of individual hedge funds, each managed by professionals who spent their careers analyzing markets, building models, and executing strategies designed specifically to beat average returns. The S&P 500 index fund required no such effort. It simply owned the market. 10 years later, the index fund had returned 125.8% cumulatively. The average of the 5 hedge fund portfolios had returned 36.3%. The gap was not close. The gap was not explained by bad luck or an unusual period. It was explained by fees, by the structural impossibility of the average active manager outperforming the average market return before costs, and by the compounding damage that costs inflict on returns over time. Buffett donated his winnings to charity. The lesson that most experts cannot consistently beat a simple index fund after fees, and that the attempt costs investors more than the expertise is worth, received less attention than the size of the prize. This is not a new finding. It is not controversial among researchers. It is one of the most replicated results in all of financial economics, confirmed across asset classes, geographies, and time periods for more than 50 years. And yet, the active investment management industry manages approximately $50 trillion in assets globally as of 2025. It is one of the most profitable industries in the world, built almost entirely on a promise the data shows it cannot reliably keep. I'm Stella. This is Stella Insights. Understanding why this is true, not just that it is true, but the structural reasons it must be true, changes how you think about every investment decision you will ever make. The arithmetic that makes this inevitable. Start with the math because it is the foundation. The stock market, at any moment, is owned in aggregate by all investors combined. The average investor, before costs, earns the average market return. This is not a probabilistic statement. It is a mathematical identity. For every investor who earns above the average return, another investor must earn below it by the same amount. The game of active management, identifying mispriced securities, timing market movements, selecting fund managers who will beat the index, is a zero-sum game before costs. After costs, it is a negative-sum game. Every dollar paid in management fees, trading commissions, and fund expense ratios reduces the pool of returns available to investors as a group. The average actively managed fund investor, after costs, must earn below the market average by approximately the amount of fees paid. This is not a theory. It is arithmetic, first articulated precisely by Nobel Prize-winning economist William Sharpe in 1991, one of the most important and most ignored documents in the history of personal finance. The empirical evidence confirms what the arithmetic predicts. The SPIVA scorecard, S&P Indices versus Active, published semi-annually by S&P Dow Jones Indices, tracks the performance of actively managed funds against their benchmark indexes, across all major categories. Its findings are consistent across every reporting period. Over any 15-year period, more than 90% of actively managed U.S. equity funds underperform their benchmark index after fees. Over 10 years, more than 80% underperform. Over 5 years, approximately 75% underperform. The active funds do better over 1 year, roughly 40% beat the index. But the survivors don't stay survivors. Fewer than 5% of funds that outperform their benchmark in one 5-year period continue to outperform in the following 5-year period. Past outperformance does not predict future outperformance. The skill, if it exists, does not compound. The fees compound against you with mathematical precision every single year. The person who proved it without trying. In 2009, a 34-year-old teacher in Minnesota opened a Roth IRA at Vanguard. She was not a finance professional. She had no investment background. She set up an automatic monthly contribution of $400 and chose a target date 2055 fund. She did nothing else. She did not check her account during the 2011 European debt crisis, the 2018 trade war sell-off, the 2020 pandemic crash, or the 2022 bear market. She simply continued the automatic contribution every month for 15 years. As of early 2025, her account balance was approximately $147,000 on approximately $72,000 in total contributions. Her annualized return was approximately 8.4%. Over the same period, the average actively managed U.S. equity fund returned approximately 6.1% after fees, and the average investor in those funds, accounting for behavioral timing errors, earned approximately 4.2%. She outperformed the average active fund by 2.3 percentage points annually, and the average active fund investor by 4.2 percentage points annually through complete inaction, zero expertise, and a 0.12 fund expense ratio. She did not beat the market. She captured it almost perfectly at nearly no cost. In a world where most experts fail to beat the market, capturing it at minimal cost is the winning strategy. What the fees actually cost you. The fee arithmetic deserves a concrete illustration because the numbers are consistently underestimated. Consider two investors who both start with $50,000 and contribute $500 per month for 30 years, earning a gross return of 8% annually. Investor A holds a total market index fund with an expense ratio of 0.04%, approximately the cost of a Vanguard or Fidelity index fund. Investor B holds an actively managed fund with an expense ratio of 1.0%, well within the normal range for actively managed domestic equity funds. The fee difference is 0.96 percentage points annually. After 30 years, Investor A has approximately $862,000. Investor B has approximately $710,000. The difference is $152,000, paid in fees for management that the SPIVA data shows was more likely than not to have underperformed the index anyway. Add a 1% annual advisory fee on top, which is standard for advisor-managed accounts. Investor B's total annual cost is now 2%. Their ending balance drops to approximately $582,000. The cumulative fee cost is now $280,000, paid for the statistically likely outcome of underperformance. This is not a worst-case scenario. It is the median outcome based on actual performance data. Why people keep paying for active management anyway. The industry persists for reasons worth understanding, because the same forces may be acting on you right now. The first is the narrative appeal of expertise. Human beings are wired to trust experts in domains of specialized knowledge. The expertise premium is real in most fields. Finance is unusual because markets aggregate the expectations of millions of participants simultaneously, incorporating available information into prices faster than any individual analyst can consistently exploit. The market is not a passive object that experts can outsmart. It is the collective intelligence of millions of competing experts. Outperforming it consistently requires being right when the collective is wrong, repeatedly, which is a different and much harder problem than being a skilled analyst of individual companies. The second is survivorship bias. For every fund that had a spectacular decade, dozens tried the same strategy, failed, and quietly closed. According to SPIVA's analysis, more than half of all actively managed funds that existed 15 years ago no longer exist today, merged or liquidated after periods of sustained underperformance. The funds that survive long enough to be measured are already a positively selected sample. The ones that closed are excluded from the performance statistics. Including them would make the active management record look worse than the SPIVA data already does. The third is fee opacity. Most investors have a genuinely poor understanding of what they pay in total investment costs annually. A 1% advisory fee on a $300,000 portfolio is $3,000 per year, every year, whether the market rises or falls, whether the advice adds value or not. When presented as a dollar amount, clients frequently reconsider the value proposition. When presented as 1% annually, the cost feels abstract and the value feels intact. The fourth is behavioral fragility. Index investing sounds simple and is simple in theory. In practice, the do not sell during downturns instruction is where the strategy most frequently fails. The 2020 pandemic crash took the S&P 500 down 34% in 33 days. Investors who sold and waited for stability missed a 100% recovery that unfolded over the following 12 months. According to Dalbar's 2025 data, the average equity fund investor earned approximately 4.3% annually over 20 years, compared to the S&P 500's 9.7%. That 5 percentage point gap exists almost entirely because of behavioral errors. An advisor who successfully prevents a client from panic selling during a crash may genuinely earn their fee many times over, not through stock picking, but through behavioral guardrails. Knowing which service you are actually receiving and whether the price is proportionate is the relevant question. The teacher from Minnesota beat the average professional fund manager for 15 years by doing absolutely nothing. Most people watching this are either paying for active management right now or have never looked at what they're actually holding and what it costs. Do you know your expense ratio? Drop it in the comments. And if you've already switched to index funds, tell us when and why. How to actually do this. The practical implementation is straightforward and genuinely available to everyone. A 3-fund portfolio, a total U.S. market index fund, a total international market index fund, and a total bond market index fund held in proportions appropriate to your time horizon and risk tolerance at Vanguard, Fidelity, or Schwab provides exposure to virtually every publicly traded company in the world at a combined annual cost of approximately 0.04% to 0.10%. It requires rebalancing once or twice per year, a task that takes approximately 20 minutes. It requires no market timing, no economic analysis, no view on individual companies, and no expert. Target date retirement funds reduce even the rebalancing step to zero. The 2050 Target date fund at Vanguard, Fidelity, or Schwab does everything automatically for approximately 0.2% to 0.15% annually. The investor contributes money. The fund manages the allocation. The investor retires. The evidence that this approach outperforms professional active management over long holding periods is extensive, consistent, and not seriously disputed by anyone who has examined it honestly. The industry's current response to this evidence is not to dispute the data. It is to move the goalposts, arguing that the real value of active management is behavioral coaching, not stock selection. This argument has genuine merit. Behavioral coaching is a real service worth paying for, but it is worth paying for it clearly and consciously, priced separately from the fund selection claims that the data has dismantled. A financial plan from a fee-only advisor is a different transaction than an actively managed fund. One may be worth the cost. The other, for most investors over most time horizons, is not. The only thing that matters. The bet Buffett made in 2007 was not really about whether any particular hedge fund was bad. It was about whether the structural reality of markets, that active management in aggregate cannot outperform the market it draws from after the costs of attempting to do so, would express itself over a long enough period. It always does. The experts who underperform are not usually bad at their jobs. They are often brilliant, hardworking professionals operating in markets efficient enough to deny consistent outperformance to even the best among them. You do not need to be smarter than them. You do not need to find the one manager who will consistently outperform for the next 30 years. A search the persistence data shows is futile, even in retrospect. You need to buy the market at the lowest available cost, contribute to it consistently, regardless of what headlines are saying, and not sell when fear tells you to. That strategy will outperform most experts most of the time. Not because you are exceptional, but because the arithmetic of the situation is on your side. It always has been. The only question is whether you will use it. If this changed how you think about what you're invested in, subscribe to Stella Insights. This is what we do here. The financial decisions that actually move the needle, explained without the noise. And if you know someone paying 1% or more for active management, send them this video. The math doesn't get easier to ignore the longer you wait. See you in the next one.